Hi, everybody. My name is Ty Kiesel from NAV. I'm the creative director,
Hi, I'm Jerry Detweiler, Education Director for NAV.
and we're going to talk about something that is near and dear to my heart. Is business debt good or bad? And I think that the answer is maybe. I attend, if you've been listening to us over the last 12 months, you've probably heard something similar to this before, but years ago, I was on a conference, a panel at a conference of Amazon sellers, and someone asked the question, when should I borrow and how much should I borrow? And one of the other attendees on the panel said, borrow as much as you can whenever you can, because you never know when you're going to have a chance to borrow again. And I think that is not very good advice, because borrowing, regardless of where you get it, could be good, but it also could be bad because it's expensive. So we're going to talk today about some of the reasons why you would want to borrow, what circumstances make sense to borrow, and maybe some circumstances that don't make sense. So we're going to cover what is business debt, when taking on debt, when could it be beneficial, when could business debt not be beneficial, and how do you help evaluate your situation? What are some questions you should be asking yourself before you get into debt? And so, with that, Jerry. Do you want to talk? Whoa, boy, Jerry, do you want to
I'd love to.
kick us off and start talking about what is business debt?
Yes. So, business debt is essentially debt you take on for a business purpose. And it could be in the form of a personal loan if that's all you qualify for. But if you're using it for a business purpose, then I would say it falls under business debt. And Ty, when you were talking about this whole notion of is it good or bad and when do I borrow? There are some advisors or experts I'll run into in our space who will say, well, you shouldn't borrow. You should just bootstrap your business. And in fact, I think a lot of business owners would prefer to bootstrap their business and not to have to take on debt and borrow. But sometimes it's really essential. I'll give an example. I was just reading this week about a couple who had started a waterproofing and I think moisture remediation business. And they were starting to really get traction with government and commercial contracts. So these are big contracts that could really grow their business. But at the same time, they were finding that these contracts often paid in about 60 days. And in the meantime, they needed to put out money for labor, for equipment. They needed to insurance, surety bonds to take on these big projects. And that would either have to come from cash flow or by borrowing. So, by borrowing responsibly, they were able to take on more and more business to grow their business. But of course, they had to make sure that they were doing it in the right way. So, to me, that could be an example of good business debt.
I 100% agree with you, Jerry. Um, I I would never advocate borrowing just to borrow. However, if you can leverage borrowed capital into um, a benefit to your business, I think that borrowing makes sense. And we're going to talk a little bit more about that now. So, typically speaking, it takes capital to grow and fuel growth. And that's the first thing we're going to talk about. If your business needs capital to, maybe you're a restaurant and you want to expand across town, or maybe you're a construction company that wants to buy a new front end loader, or any type of equipment, and you have a solid plan that will enable you to pay it back, that's a great reason to borrow. And depending upon the interest rate, and we're going to talk about some ways to evaluate this in a minute, but depending upon the interest rate and the cost of the financing, it could be a good opportunity to grow. I'm a big fan of leveraging borrowed capital when it makes sense, but not just to have extra money. I think that popular media would have you believe that extra capital is the solution to every problem that a business owner faces. And that is just not accurate. It takes more than business capital. So, Jerry, do you want to talk about building business credit?
Yes. So another way to leverage business financing or business loans is to help build business credit. So many types of business credit or business loan products, including business credit cards, typically do report to commercial credit bureaus. And that contributes to a strong credit rating for your business. Now, obviously, you want to be able to pay it on time because if you don't, that will hurt your business credit. But if you can build business credit this way.
Another reason that I think makes sense. I grew up in a small business working with my father, and his attitude was there are two reasons to borrow. One is to increase the value of your business, and the other is to increase ROI on a specific project. And I think increasing ROI on a project is a great reason to borrow. Treat the borrowed capital the same way you would the cost of goods you're going to sell. Make sure that if you borrow, like to purchase quick turnaround inventory or something like that, make sure that you have that the cost of the borrowing does not negatively impact the ROI on the project. And if it doesn't, and you can borrow quickly and respond to an opportunity to increase ROI, I think that's a great reason to borrow.
Yeah, and let me just add there, if the talk about ROI kind of gets your head spinning because you don't really like to focus on the nitty-gritty numbers of your business, keep in mind that your accountant may help you with this, or you can reach out to an SBA resource partner and get free help. So that's from your Small Business Development Center or your a SCORE mentor, both of whom can help you for free to create a business plan that will allow you to drill down into these numbers.
That's great advice, Jerry. I think that the SBDCs and SCORE both have lots of people who are engaged in helping small businesses, and that's great advice. Um, do you want to talk about this first one, Jerry?
Sure. So you definitely want to avoid taking on business debt if you can't pay it back. And I know that sounds very obvious, but what will happen sometimes is business owners will get into a very expensive debt and they'll be trying to solve a short-term problem, but the debt is so expensive that they just dig the hole deeper. And I have seen this so many times over the years where it gets to a point where the business just can no longer dig out and can no longer function. So you do want to understand the cost of the debt that you're taking on so that you can understand, what it will take to pay it back.
This second one I feel really strongly about. We're going to talk more about it in just a minute, but you don't have a good use. I think that why you're borrowing is almost more important than how much you borrow and what the terms are, because it's going to help you make a lot of decisions. Borrowing can be expensive. Even a low interest rate loan is expensive if you're not borrowing for a specific purpose. Any interest you pay can add up. In fact, this will probably be the only webinar that you ever hear from a lending site that's going to say, maybe you shouldn't borrow, because there are circumstances when maybe you shouldn't. But if you have a defined loan purpose and you can put additional money behind it to reap the rewards of that particular purpose, that's a good time to borrow. However, if you're borrowing just to borrow and it's going to add additional financial stress to your business, you could be borrowing your way out of business. And that happens every year to probably millions of small businesses.
Absolutely. And then, of course, we go back to that ROI on the, borrowed capital. And again, if you don't know how to calculate that, if you don't really understand the cost of your loan, I'm going to give you two resources. One is NAV has free calculators. You can go to nav.com/calculator, and there we have free calculators there that will help you translate the cost of the small business financing into an APR. And the other is SBA.gov. And if you just look on there, you'll find the SBA resource partners who can help you for free as well.
Great resources, and I would encourage you to take advantage of them if you're curious about how to track ROI. Now, this is something that I think is really super important. If you're thinking about taking on a business loan, there are 3 or 4 questions you need to ask yourself. One is, and we kind of talked about it a little bit, what is my loan purpose? For example, if you're borrowing to buy inventory, or you're borrowing to purchase a piece of equipment for your business, or you're trying to move across town, or you're looking to borrow a commercial vehicle or something, all of those loan purposes are significantly different enough that they're going to impact where you look for a loan and how much you can afford to pay for a loan. So the first question you should always ask yourself before you start thinking about where am I going to go and how much do I need to borrow is, what is my loan purpose? And then the next question is, how much capital do I really need? And if we go back to my first example, borrow as much as you can, I fundamentally disagree with that advice. Borrow what you need and no more. Your loan purpose is going to help you to determine how much money you actually need to borrow, and that's how much you're looking for. Borrowing too much can become even more expensive and cause you great problems down the road. The next question that is going to be helped by the first answer is, what term makes sense for this loan purpose? There are loan terms available to you for anywhere from 3 to 6 months to 10 years. And depending upon why you're borrowing, you should consider different loan terms. I like to put it this way. If I was going to buy a new car, I probably wouldn't get a 30-year auto mortgage. And I don't think very many people would. The interest rate might be incredibly low, but over the 30 years, the accumulated interest on that auto loan would be so expensive, it would be just unbearable. But in the same way that I wouldn't get an auto loan for 30 years, most people don't get a 3-year house loan, a 3-year mortgage, because it just doesn't make sense, because the payments would be so high. So when I'm looking at advising someone who is talking to me about what type of financing should I get, I'm going to ask them, what's your loan purpose? And they're going to tell me. And if it's say buying quick turnaround inventory, for example, I might recommend a 3-month or a 6-month term, because they can get in and out of the financing quickly, and they can borrow again to do the same thing next year. But if they get into a 4 or a 5-year term loan to borrow on equipment this time, that's going to mean they're in a bind next time, because they're not going to have access to the financing that they need. So, think about it. A short-term loan, the interest rate will likely be a little bit higher than a longer-term loan, but the accumulated interest over time will be less. And although a lower interest rate loan for a longer term it makes sense in some circumstances, it doesn't always make sense. So when you're looking at loan purpose, think about what you're borrowing for, so that you can make the right decision about loan term. And then the next question is, what does my business's financial situation look like? And now you're going to start thinking about specific lenders. There is a correlation to how easy financing is to get and how qualified a borrower is. The lower the interest rate, the better qualified the borrower. In other words, the better the better credit profile they're going to have, etc. So be honest in evaluating your situation and before you decide where you're going to look. Because if you don't have a credit score in the 700s, it's going to be really difficult to go into a bank to get a loan. So what is my loan purpose? How much capital do I really need? What term makes sense for my business? And what does my business financial situation look like?
Yeah, those are all great questions. So you do need to do your research and think about, how you're going to use the funds, what is it going to cost, and what can you repay. As Ty mentioned, most small business loans will be tied to your qualifications. So that will be your time in business, your revenues, and your credit scores. And if any of those things are weak, your options will be more limited and likely more expensive. So, in some cases, you're going to find that you're going to have to start out smaller than you want. Even though you may want to borrow, for example, $50,000 or $100,000, maybe right now you're just going to be able to borrow $5,000 or $10,000 for that immediate need. But if that can get you to the next level, that may be the most realistic scenario for your business. And when you talk about how much do I need, you do want to make sure that you're talking to your advisors or looking to your business plan so that you fully understand how much you need. Now, having said all that, one option that some businesses will have in their back pocket is a line of credit. And a line of credit simply gives you money that you can borrow from when you need it. And I like to think of it as sort of a financial insurance policy for your business. So even if you get approved for a line of credit from your a lender for $50,000, that doesn't mean you need to borrow $50,000. You may not need to touch that line of credit for a little while, or maybe you borrow a small amount and pay it back. But generally, knowing how much you need is going to be a really important calculation here.
So let's talk a little bit about the qualifications. Generally speaking, we've kind of touched on this a little bit. If your credit score is at least 550, the odds are better for you. However, the better your credit score, the more opportunities that you're going to have. Now, if you have a 750 or a 780 credit score, that is not going to guarantee that you'll get a loan, but what it will guarantee is that you're going to have a lot more options than a borrower with a credit score of 550. So you do need to focus on your personal credit score as well as your business credit profile, because for most small business owners, your personal credit score is always going to be a factor. And so the better your personal credit score, the more options you're going to have and the more choices you're going to be able to make. Jerry, do you want to talk about revenue?
Sure. So revenue is extremely important to most small business lenders, and typically they're going to want to verify your revenues either with a business tax return or more likely these days, business bank statements. So you need a business bank account that you can supply the last 3 to 6 months of statements for, or they'll ask you to link it electronically so they can analyze the revenue through their systems and see whether you qualify. Generally, they want to see revenue coming in from multiple sources, not just one client or customer. And they'll want to see that revenue isn't, for example, on a downtrend, that it's a steady or on an uptrend. But your business revenue is essential, and part of that is your business bank account, which if you don't have, you need to open now.
There are a lot of lenders. Jerry and I have talked about this several times over the last 18 months. There are a lot of lenders that won't even consider your loan application if you haven't got a business bank account. It's that important. You need to make sure that you have a business bank account. And if a lender wants to electronically link to your bank account, that's a good thing. It's good for the lender because it gives them an opportunity to verify the information. Verified data is more valuable to them than non-verified data, but it also really benefits you. It streamlines this process incredibly so that, if you have a lender who wants to connect to your bank account, It's a read only. They can't do anything in there to modify the numbers or anything like that. It's just a good idea to do that. And time in business is really important. Um, One of the things that lenders want to look at is your track record. And the longer your track record, the more comfortable they are with offering you a loan. There are traditional lenders who want to see several years in business, but there are a lot of lenders who will, if you've got a year or two in business, you will probably meet that criteria. And there are even some lenders that will offer you financing if you've been in business for 6 months. Just be aware, we talked before about how that correlation between qualifications and cost exists. It really does in this category as well. Financing might be available for a business that's got 6 months in business, but it will likely be more expensive because it's a higher risk because you haven't got a track record long enough for the bank to feel comfortable. So you want to consider what you could qualify for, consider the cost of those options before you make a decision whether or not to get a loan. Jerry, do you want to go through this slide with us?
Sure. And I should add too, on Ty's last slide, that if you're a startup, there are startup financing options out there. They're just, you have to get pretty creative. Most traditional lenders, they're not looking to play Shark Tank, be an investor in your business. They want to take a calculated risk. So if you have a startup and you're looking for financing, you can certainly look at our presentation on startup financing as well. So what do you do with this information? Well, hopefully we've given you some things to think about when it makes sense to borrow, when it might make sense to wait or to think about your options more carefully. But one thing you can do right now is to utilize a free NAV account, because when you sign up with NAV, it'll be a soft credit check. It will not impact your credit scores, and we will not sell that information to lenders. Instead, what we're going to do is try to bring the lenders to you based on your qualifications. So within your NAV account, you'll see what's a match. Now, the more you fill out your profile on your NAV account, the better the matches, because as Ty mentioned, verifiable data is gold to lenders, and lenders do want to lend. They have gone through the pandemic, in many cases, not doing what they do best, which is lending money, and they want to do that. And we're seeing so many lenders that are eager to find qualified customers. So your NAV account is completely free. We won't sell your information to lenders. It's a soft credit check, and then we'll show you matches based on your profile. Now, I had also mentioned our calculators earlier, and those can be really handy. So if you get an offer from a lender and it's expressed as a fee or as a factor rate or something you're not familiar with, you can go to nav.com/ and actually there's a shorter link than what's on the screen, just calculator. I think it's singular, that will take you to our calculators and let you use those for free just to translate the cost to an annual percentage rate, or APR, which is what we're used to using in the consumer world. So do that so you can understand, hey, if you get a financing offer that's at 57% APR, maybe you're better off with your credit card that has a 19.8% APR. It just depends on the circumstances and what makes sense for your business. And then finally, we have so many different webinars on different types of financing, walking you through everything from startup financing options to trade lines and vendor credit, to what types of loans are available when, SBA loans. There's so much out there, and sometimes it can feel overwhelming. So our goal is really to simplify it for you and help you spend less time searching for financing and more time getting what you need so you can get on with your business.
I'm convinced that there are more financing options available today than ever before, for a wider variety of small businesses than ever before. But it's going to require you to be a little more savvy when you're looking for financing. You don't need to be an expert in small business finance, but you do need to have an understanding of what type of financing makes sense for you based upon your loan purpose and some of those other things we've talked about today. So I I appreciate your being here to join us on this webinar. I hope this information has been valuable for you. Please check out some of the other webinars that we have already published that are going to talk about the different types of financing available and maybe some of the other strategies that you can take to build your credit. I'm a huge advocate of taking a strategic approach to borrowing, and the things we've talked about today are probably the first steps. So thanks again for joining us, and hope you have a great week.